It's Monday, September 7, 2020, Labor Day. Episode number 64 is an Airbnb active or passive income. This is the 39.6 Facebook Live Finance Show, the show that teaches high earners like yourself how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, Airbnb syndications, and even the car you drive. Thank you to everybody who's joined our Facebook group. We are up over 460 members. If you're out there and you can see and or hear, please let me know in the comments. Make sure the audio and video is working on your end. All right. So, yesterday, episode number 63, we talked about when not to take bonus depreciation. Today, we are going to talk about active and passive rentals, and this is a little bit related to yesterday's topic because we talked about why you wouldn't want to take bonus depreciation yesterday. And for a lot of people who aren't full-time real estate professionals, it doesn't really make a difference. If you are, you want to kind of gauge how much you're going to be taking. Now, that's particularly pertinent to passive rentals because of the passive activity loss limitations. Now, short-term rentals, Airbnb or VRBO/home away, this is a different industry. This is the hospitality industry more than it is just the real estate rental industry. Okay, and so how you file it gets to be very confusing. For some reason, the IRS has determined that long-term residential real estate, by definition, is a passive activity, irrespective of how much activity you put into it. Okay, you could spend 800, 900 hours, but it's not your primary job. And if it's a long-term rental, it's a passive activity, no matter what. So Airbnb short-term rentals, these are different. There are different rules, and I haven't personally seen the IRS come down clearly with what their rules are. This is a very controversial topic, and even the sources that I look at, sometimes they don't even agree with itself when I read the documents. And then I read different documents from different sources, and they have different opinions. Okay, so this is a very shades of gray area, and different accountants will also interpret the information differently. And this was something that was very important to me when we were filing taxes, when we started doing Airbnb, to the point where if my CPA and I did not agree on how to file this, I was just going to find a different CPA, because I knew that there would be a CPA who would feel comfortable filing it the way I wanted it to be filed. Okay, and so there's pros and cons to each filing type, whether it's passive income or active income. Okay, so on your tax documents, Schedule C is for active income. That's basically, if you're a sole proprietor, you're getting a 1099, you're going to file that on Schedule C. Okay, for a job if you're an independent contractor. On Schedule C, you'll take your income and your expenses. Then you'll also have to pay self-employment tax on any profits, self-employment tax being payroll taxes, Social Security, and Medicare. And then whatever is your net income, you pay tax on that. Now, if you have active income that is positive, you can also take a retirement contribution from that. You could do like a SEP IRA or solo 401k, for example. Now, if you are filing on Schedule E, which is passive activities, okay, so that could be long-term residential real estate. It could be short-term potentially real estate like an Airbnb or VRBO, depending how you categorize it. Or it could be a passive investment in another active business. Okay, so that's Schedule E. Schedule E, because it is not active income, does not subject you to paying payroll tax, Medicare, or Social Security on any positive taxable income. So the big benefit of Schedule E is you get to bypass payroll taxes completely. Remember, the IRS taxes most heavily people who are working for their money and taxes less people who aren't working for their money. Okay, so the big benefit of Schedule E is you can avoid payroll tax. That is a lot. For somebody who does not have any other jobs, has no other Social Security payments, you're paying Social Security on both sides, employer and employee side, plus Medicare on both sides. So Social Security is 6.2 times 2 is 12.4, and then another 1.45% for Medicare on each side. Okay, so that's another 2.9% on top of the 12.4%. So it's 15.3%. That's before counting the additional 0.9% if you earn $250,000 or more. So you're very highly taxed, over 15% just on payroll for Schedule C income. You still have to pay federal tax. So Schedule E can be highly beneficial in certain situations, in particular, if the taxable income is positive. Now, Schedule C is detrimental if you have positive income because you have to pay payroll tax at 15%. The one benefit is that you do get to contribute to a retirement account from a Schedule C income. You can't do that from passive income. Now, if you have a loss, Schedule C is the best place to have that loss because that is an active business loss. That counts as literally like losing money off of your 1040. There's no limitation to how much you can lose on your Schedule C. It will, no matter what your income is, transfer to your 1040 as a deduction off of your regular W-2 income. Okay, so that all being said, if you're going to do a short-term rental, you want to design it such that it is ideally as tax efficient as possible. So if you are going to be generating losses, you would like it to be on Schedule C. And if you're going to be generating gains, taxable gains, you would want it to be on Schedule E. Both of them are going to have depreciation applied. So you're still going to have depreciation help decrease your income. And for long-term rentals, you're usually going to see a negative number. For a lot of active short-term rentals, the margins are so much higher that they're generating a taxable profit. Okay. So even with regular standard straight line depreciation. Okay. Basically the building value divided by 27.5. So you kind of want to design how you're going to tax it based on how it's going to earn its money. And you might not know how successful your business is as an Airbnb or a VRBO right away, but over the course of the year, you can try to figure it out and you can steer it towards Schedule E or Schedule C based on what it's looking like. So, for example, this is one of the guides. This is the one that I have found to be the most useful. This is from H&R Block. I'm going to link this to the comment feed under this video. Okay, but this was published in 2018, so just a couple years old. This flowchart basically guides you how to consider something as being a passive activity or a non-passive activity. I'm going to call that an active activity. Okay, so the first thing is, here you go, you start. This is where you play in the board game here. You roll your dice, and then you get to your first question. Did you spend 500 or more than 500 hours in the activity? Remember, for real estate professional status, it's a minimum of 750 hours. Here they use 500, which is honestly the only place I've seen the 500-hour rule placed, but they start with that. It's pretty easy if you're self-managing an active Airbnb for you to reach a total of 500 hours. If you're doing turnovers every couple of days, if you're actually turning the place over, you can easily get to that. Now, you're likely going to outsource the turnovers in terms of cleaning and whatnot, but there's still often some work to be done, especially if you self-manage. And if you include other activities that are real estate related, 500 hours is not that hard to get to, although it's still about 9 hours a week. Okay, but you throw in some conferences here and there, you can get your numbers high enough. But let's pretend you can't hit 500 hours and you're outsourcing a lot of it, most of it. Did you spend at least 100 hours and more than anyone else? Okay, so we actively managed our Airbnb. It was our homestead. So we did not use one of those services that just completely takes over the vacation rental service. So we still did the bookings through the app. We would vet our renters and we would coordinate with our housekeeping service to turn the property over. We would still usually check on the property to make sure it was ready for the next guests, things like that. Okay, so 100 hours, not that hard to get to. That's less than 2 hours a week, especially with a handful of conferences that are real estate related, and just talking with the tenants and setting them up for basically booking them. And then if you're negotiating a contract for an extension, things like that, it's easy to rack up some hours. Okay, so 100 hours, not that hard a threshold to get to. Most people can do that. So if you got to 100 hours, then you file here, was the average rental 30 days or less? If you're running an Airbnb or VRBO, it's most likely going to be less than 30 days. We've definitely had some 2 to 3 month renters who we have booked through Airbnb who've extended. Often it's like an insurance claim and they need 8 weeks to get their house fixed, something like that. But you scatter in a handful of short-term rentals and the average goes down pretty quickly. Okay, because you can get 1 month, you could put in 10 renters and then you could just fill the rest of the year with a few 8-week bookings and your average is going to be well under 30 days. Okay, then the question is, did you provide guests significant personal services? Now that is a little bit, again, a gray thing. They say substantial services include cleaning of the rental portion of the property while occupied, kind of like what a hotel would do. Now, when we have long-term bookings, we do routinely provide them housekeeping services because we want to make sure our housekeeper gets the work. So we often do that for our tenants. If they want to bring their own housekeeper, that's fine. But we often, for people who are there, provide weekly housekeeping if they're going to be there for more than a week. Okay. We don't provide concierge services per se, but we are available through the app for them to communicate with us. We don't do guest tours or outings. We don't directly provide meals and entertainment, but we usually often leave them food, especially for people who are going to be there for certain amounts of time. And we often give them kind of like a welcome thing for breakfast the next day. We do not provide transportation, but we usually do some of those substantial services. Now, we've kind of varied on how much we've done as we've gone through our experience with Airbnb. But the key here really is, even if you don't provide that, was the average rental 7 days or less? Okay, so if you spend 100 hours a year and keep the rental 7 days or less, you can consider this non-passive. That's probably the easiest way to do it. Even if you don't reach 100 hours, it says, were you a material participant in any 5 of the last 10 years? So you'd need to have it going for a number of years to reach that. But 100 hours per year and average rental 7 days or less. Okay. So we keep track of those rentals. And even though we had 2019, we had multiple long-term bookings, we kept the average rental well under 7 days. Okay. Now, we do this because with the depreciation, our property is pretty expensive. The depreciation, even with straight line, is pretty substantial. Okay, so the building value is around like 750. Okay, and if you divide that by 27.5, that gives us $27,000 per year of depreciation. Okay, and sure, we could generate positive cash flow and above that 27,000 and take that 27,000 off from depreciation and still be positive. But for 2017 and 2018, we were able to generate a negative taxable income because of the depreciation and a bunch of other real estate related expenses that we expense to our Airbnb. There's a lot of expenses you can expense to an Airbnb. It's a business, it's an active business, meeting with clients, doing a lot of other real estate types of things that otherwise we would have deducted from a Schedule E business. We could elect to expense it to our Schedule C business where those losses actually matter. On a Schedule E long-term rental, we don't really get to have that benefit. We just baking in a bunch more losses to carry forward to subsequent years. It's much more valuable to take an expense on Schedule C income. So we expense a lot of things into our Airbnb, and so we can generate a lot of losses. So 2017, 2018, just using regular straight line depreciation, we were able to get below zero, and those losses applied to our 1040, and we were able to decrease our taxable income a good amount. Okay. Now, 2019 was the first year that we actually used our Airbnb our property almost exclusively as an Airbnb the whole year. And so we were living in an apartment. We decided to just try to rent it out the whole year, see how we would do. Prior to that, we did mostly weekends and like holiday weeks, things like that. We didn't really rent it out full time. But we got a nicer apartment in 2019 and decided to push it to the limit, see what we could do. And it's interesting because as we got more experienced, we decided we would try less hard to kind of like book every day, but just work a little harder to get bigger bookings. And that's really where the money was. We had multiple insurance claims. And when people are renting out for 8 weeks with no vacancy, you make a ton of money. So we grossed like 170 last year on our Airbnb. And that was fantastic. And like 4 months of that was like 1 or 2 renters. So without really much turnover to deal with, it might have been closer to 5-6 months. I don't really remember, but it was most of the summer and then the fall were just like 2 renters. And we didn't have any short-term turnovers actually once the summer started. So it was very painless in comparison to previous years, and we made a ton more money. But a lot of this was just kind of maybe fluke associated with some of the weather events that happened last year and some insurance claims that people had. So we ended up generating a bunch more positive cash flow than we have historically in previous years. And so after going through all of our expenses on our personal return that was going to go to Schedule C, even with depreciation and even throwing a ton of expenses at our Airbnb, we still had a lot of taxable income, which is a great problem to have. It's a very good problem to have. It means you're making a bunch of money, right? But now we were going to have a Schedule C item that was positive tax liability. And that's like not ideal. And then I was thinking, well, maybe we can put it back onto Schedule E this year. Okay, we maybe could. And it would just save me from paying payroll tax. But if I put on Schedule E, I wouldn't be able to take a solo 401k or a SEP IRA contribution from that taxable income, because that's one of the benefits of having positive taxable income is I can at least take a whole bunch of that and shelter it in pre-tax dollars. However, I would have to pay payroll tax, which is still payroll tax. Granted, Social Security, we've already maxed out for the year. So it would be Medicare However, I think I still have to pay the employer side of Social Security. So it was still going to be a good amount of payroll tax we were going to have to pay. I think something like maybe $10,000. So payroll tax is like, I don't know, that's the one tax you really don't want to pay, because if it were structured in a different way, you wouldn't have to pay it at all. So that's really kind of, it's not like federal tax where you can't really get away from it. So that's the situation we're in. And that's why I brought up the bonus depreciation thing yesterday, because we're in the process of getting cost segregation on it. So yes, so this gets actually pretty interesting because it's an active property, active business, we can actually take losses and apply them to our 1040. So we can do a cost segregation analysis, and we can choose to take bonus depreciation as well, and we can see where that gets us. I might take a cost segregation and apply the cost segregation without taking bonus depreciation, or I might do a cost segregation and apply bonus depreciation. And my CPA was pretty excited, I think, in discussing this with me. And we sent it. I talked to I don't know if it's an engineer company to get that cost segregation analysis. I looked at a couple online that they seemingly can get you a cost segregation analysis like super quickly, and makes me wonder what they're actually doing. They're just making some ballpark estimates, but the value of the property is really high, and I want a local person to do this analysis and get that cost seg high. So I don't know. We're gonna wait to see what they come up with. I took pictures of the blueprints because I have them from the builder, and have the architect's contact. And anyway, hopefully they get back to me in a few days, and we'll do another episode on this. But it's very important to, if you are thinking about doing an Airbnb or short-term rental, designing it in such a way so that it is maximally tax beneficial to you, if you can, without necessarily losing income. So it's really just basically looking at the average days of rental. And if you're trying to get onto Schedule C, just get a bunch of short bookings to get the average rental term low. If you're trying to get on Schedule E, try not to schedule as many short bookings and try to keep them a week or more. It's not that hard to do, but Airbnb can definitely be a lucrative way to utilize and leverage real estate to make money. But it is more time intensive, resource intensive, and not as necessarily sustainable potentially as a long-term rental, because it does fluctuate more so based on economic and local dynamics, right? Like COVID. So there you have it. Airbnb active or passive income, Schedule C or Schedule E income. It's for you to decide. I'm going to put this in the comments. There's also another website called passiveairbnb.com with great resources, and there's a link there I'll post. And the guy who wrote that article, Sam Zuo, he says, I'm not a professional, so I would recommend you to go and talk to a tax professional, but I can tell you what I did. I filed a Schedule C. So again, I'm not a tax professional either, but we have filed on Schedule C for 2016, I think, 2017 and 2018 and 2019 pending. We still have about 5 weeks to file that return. So it's going to come down to the wire. That's it for today. Episode number 64. Thank you for joining us. And until tomorrow, hope you guys all had a great holiday weekend, and help us get to 500 members. The Medicine, Marriage, and Money podcast will be launching 1 week from today, the sponsor of today's episode. I've been editing that podcast episode all day, and I remembered why I do mostly Facebook Lives, because the editing process can be the biggest time sink. So until tomorrow, have a good one.